$9 trillion vanished, and almost nobody noticed. That's right, not stolen, not spent, just gone, like it never existed. Even the smartest minds, Nobel laureates, PhDs, hedge fund geniuses, didn't see it coming. Why? They were looking at the wrong thing. And here's the uncomfortable truth. Most people still are. Every few years, someone on financial television starts using the word bubble. Twitter starts arguing about whether the stock market is overvalued. Reddit discovers some obscure economic indicator, and people either panic or roll their eyes. Neither reaction is very useful. Because the real question isn't whether a crash is coming. Crashes always come eventually. The real question is, do you understand what actually causes one? Not the surface stuff, not the headline version, the actual mechanism. Because once you understand that, really understand it, you stop reacting to financial news like a passenger. You start reading it like someone who knows how the engine works. So let's talk about how financial crises actually start. Not with a bang, not with a villain, not with one catastrophic decision. They start with something much more ordinary. They start with optimism. Here's how it always begins. Something works, a new technology, a new market, a new financial product. Maybe it's railroads in the 1840s, maybe it's internet stocks in the 1990s, maybe it's housing in the 2000s. The specific asset doesn't matter much. What matters is that it works, and then people notice that it works. Prices start to rise. The people who got in early make money, a lot of money. Word spreads, more people get in. Prices rise further. Now it looks like a sure thing. And here's where it gets interesting. When prices are rising reliably, lending gets easy. Banks are in the business of making loans, and a rising asset is very good collateral. If you borrow to buy something that keeps going up in value, even if you can't actually afford the payments, you can just sell it later at a profit. The math seems to work. So banks lend more, and the extra lending pushes prices up more, and rising prices justify more lending. You can see where this goes. An economist named Hyman Minsky spent most of his career describing this exact pattern. He called it the credit cycle. The basic idea is almost embarrassingly simple. Stability breeds instability. The longer things go well, the more risk people take, because nothing bad has happened in a while. So why would anything bad happen now? Minsky died in 1996. For decades, most mainstream economists thought he was a little too pessimistic. By 2008, they had renamed the moment of collapse after him. But optimism alone doesn't cause a crisis. Optimism just inflates the balloon. What causes the crisis is the structure built underneath the optimism. Let me give you a concrete example. In the early 2000s, American banks were giving out mortgages to people who probably couldn't afford them. You've heard this part. What you may not have heard is what happened next. Those mortgages didn't sit on the bank's balance sheet. The bank sold them. They bundled thousands of individual mortgages together into a new financial product called a mortgage-backed security. Then they sold slices of that product to investors all over the world, pension funds in Norway, banks in Germany, insurance companies in Japan. And here's the critical part. Because the bank sold the mortgage the moment it was made, the bank no longer had much reason to care whether the borrower could actually pay it back. Their job was to originate the loan. Someone else would own the risk. That someone else often didn't fully understand what they owned. The rating agencies, the firms hired to assess the risk of these products, gave many of them their highest safety rating, AAA, as safe as US government bonds. Except they weren't, not remotely. But the math used to rate them assumed that housing prices would never fall simultaneously across the entire country. They had never fallen that way before. So the model said it couldn't happen. This is the hidden mechanism at the core of almost every financial crisis. Not fraud, not stupidity, something subtler and more dangerous. A shared assumption so widely accepted that no one bothered to question it. In 2006, it was that house prices only go up. In 1999, it was that profitable internet companies were coming eventually. In 1929, it was that the stock market reflected permanent prosperity. Different asset, same architecture. Here's what makes a crisis rather than just a correction. Leverage. Leverage is borrowed money, and borrowed money amplifies everything. Gains on the way up, losses on the way down. Before the 2008 crash, some major investment banks were operating with leverage ratios of 30 or 40 to 1. That means for every $1 of actual capital they held, they had borrowed and invested 30 or 40 more. Do the math on that.
If your assets only need to fall in value by 3%, your entire equity is wiped out. You don't just lose money, you become insolvent. You owe more than you own. And when a large institution becomes insolvent, it stops lending. It starts calling in its own loans. The institutions that borrowed from it now have a problem. They start selling assets to raise cash. Selling pushes prices down. Falling prices make other institutions look insolvent. They start selling. This is what a cascade looks like from the inside. It's not one big explosion. It's 1,000 small ones, each one triggering the next. And because the financial system is so deeply interconnected, institutions lending to institutions lending to institutions, a problem that starts in the US mortgage market ends up hitting a bank in Iceland. Iceland, a country of 340,000 people, about the population of a mid-sized American city, had built a banking sector nearly 10 times the size of its entire economy. When the cascade hit, the whole system collapsed in a week. This is what happens when the shared assumption breaks. There's a version of this story you've probably heard. It goes like this. Greedy bankers made bad bets, regulators were asleep, and ordinary people paid the price. And there's truth in that. But it misses something important. Crises don't require villains. They require something far more available. Ordinary human incentives operating inside a system with no one responsible for the whole. The mortgage broker who approved a bad loan wasn't planning to blow up the global economy. He was meeting his quarterly target. The ratings analyst who gave a bad product a AAA rating wasn't lying. She was using the model everyone was using. The investor who borrowed the product wasn't naive. He was chasing yield in a low interest rate environment, just like every other investor in the world. Everyone did what made sense given their small piece of the picture. No one was in charge of the whole picture. That's the uncomfortable part. Not that the system was taken over by bad people. That the system, working almost exactly as designed, produced a catastrophe. So what do you do with this? First, recognize the pattern. Rapid price appreciation in any asset class funded by expanding credit, with a near universal shared assumption that things can only go one direction. That's the setup, every time. The asset changes, the architecture doesn't. Second, pay attention to leverage, not just your own. When you hear that a major sector of the economy is highly leveraged, corporate debt, sovereign debt, consumer debt at historical levels, that's not an abstract statistic. That's information about how far the dominoes can fall. Third, be skeptical of any narrative where the math only works if one key assumption holds forever. Real estate only goes up. Tech stocks always grow into their valuations. Inflation is always manageable. When you hear always and never in financial contexts, that's usually the assumption you should stress testing. The $9 trillion came back, by the way. It took years, and it didn't come back evenly. It came back fastest to the people who owned assets, who were positioned to benefit from a recovering market. Which raises a question worth sitting with. If the system produces crises not through malice but through structure, and if the recovery from those crises tends to concentrate wealth further, then what exactly are we stabilizing when we stabilize the system? I don't have a clean answer to that. I'm not sure anyone does.